Good morning, Dr. Behram. My teammate listed above and I will be presenting the capital structure, financial statement, analysis of the financial statements and ratio, as well as our results and comparisons from the years 2016 and 2017 for the companies that we have chosen, which are AT&T and Verizon.
Verizon Wireless. Who is Verizon? Verizon is one of the biggest telecommunication companies in the United States, and its chief rival is AT&T. Verizon was created in June 20th, 2000, when Bell Atlantic and GTE merged together to create one of the largest telecommunication mergers in the U.S. history. Its current stock rate is about $60.06, and Mr. Hans E. Vestenberg is the CEO and director. As we can see here, we can see that the common stock, as right now was trading in 2016, was trading for about 424 million, and equally the same amount in the 2017.
The equity and debt in 2016, the equity was $24,032,000. The debt was $125,026 million. And in 2017, the equity was $44,687,000, and then the debt was $134,874,000.
The current owner type, of course, the institutions, most of them that own the current stock, is $259,295 worth. The mutual funds of it is going to be $137 and $154. And the insiders is $45.49. This is also in $1 million. As we can see, the current liabilities between January of 2017 to December 31st of 2017, we can see the accounts payable, the short current long-term debt, other current liabilities, and total current liabilities of $33,037,000. Now, there are some long-term debts and other liabilities here that is in total of $212,456,000. Compared that to 2016, we can see that there was an actual growth in the total liabilities part. As you can see, it is 33 million. In 2016, it was 30 million. And also the liabilities actually was a little lower. This one was 220 million compared to 212 million in 2017. In this slide, we can see the prices of the stock in 2016, and as we can see, it was trading between $40 to $50, and we can see some specs of low 40s, like the mid 40s, and we have seen also that it can go up to the biggest in this part was $51. In 2017, it's almost practically the same. We still have the aspect of the mid 40s to about low 50s, almost mid 50s. Now, Verizon is currently investing in its 5G network across the United States. In fact, Verizon has invested about $17.8 billion. Now, these are estimates, and improving and deploying new towers, new equipment, and modernizing their towers in order to start the deployment of the 5G networks in all the cities. Secondly, Verizon still continues to innovate by outbidding. It actually merged or outbidded AT&T on purchasing Straight Path Communications, who makes the equipment for the 5G deployment. This signals that Verizon will have the upper hand in providing the 5G network in every American city. And as we can see right here, we also see that the key rival it's going to be AT&T, of course. So right now, Verizon and AT&T are the key rivals, but there are smaller rivals like T-Mobile and also Sprint.
Verizon's net working capital in 2016 was negative 3,945 million, and in 2017 it was negative 3,124 million. We can see the net working capital for Verizon has changed relatively little for the years 2016 and 2017, with only about $821 million difference. This is worrisome as Verizon's net working capital is in the negative, and it will need a greater increase of net working capital to get a net positive working capital. According to Verizon's income statement, its EBIT for 2016 is $28,172 million, and in 2017 it is $30,299 million, which is a growth of $2,127 million. Its dividends per share in 2016 is $2.29, and in 2017 it is $2.34. As you can see, the dividend per share increased between 2016 and 2017. Verizon's net income in 2016 is $13,608, and its net income in 2017 is $30,550. As you can see, Verizon's net income had more than doubled in the past 2 years. Verizon's free cash flow in 2016 is $5,751 million, and in 2017 it is $8,058 million. Verizon's cash flow is positive for both years, which indicates that the company has enough cash to finance its fixed assets and investments. According to Verizon's financial statement, free cash flow is a non-GAAP financial measure that reflects an additional way of viewing liquidity that, when viewed with the GAAP, results offer a bigger picture. The change in free cash flow between 2016 and 2017 was connected with the net cash provided by operating activities and capital expenditure. Specific changes in 2017 were due to an increase in earnings and change in working capital. This was offset by contributions to pension plans, which not only improved the pension plan, but will benefit future cash flows. Another offset was a change in method in which they monetize device payment. Verizon's liquidity ratios, according to Bloomberg, are: the 2016 current ratio is 0.87, the 2017 current ratio is 0.91, the 2016 quick ratio is 0.67, and the 2017 quick ratio is 0.77. According to Bloomberg, Verizon's asset management ratios include inventory turnover ratio for 2016, which is 41.91, and 2017, which is 46.11. Days sales outstanding for 2016 is 44.99, and days outstanding for 2017 is 59.38. 2016 fixed asset turnover ratio is 1.45, and 2017's is 4.50. Total asset turnover ratio for 2016 is 0, and 2017 it is 5.31. According to Bloomberg, Verizon's debt management ratios are total debt to total capital ratio 2016, which is 0.84, and 2017, which is 0.75. Time interest earned ratio for 2016 is 6.44, and for 2017 is 6.40. According to Bloomberg, Verizon's portfolio ratios include operating margin ratio, which in 2016 is 21.48, and in 2017 is 21.75. The profit margin, which in 2016 is 10.42, and in 2017 is 23.88. ROA is 5.38 in 2016 and 12.01 in 2017. 2016 ROE is 67.4, and in 2017 it is 91.74. and ROIC in 2016 is 10.47 and in 2017 is 18.78. According to Bloomberg, Verizon's market value ratios are price divided by earnings, which is in 2016 is 14.57 and in 2017 is 14.17. Its market book ratio, which in 2016 is 9.77 and in 2017 is 5.01.
AT&T was established in 1983. It is a holding company that provides communication and digital entertainment services in the world. AT&T and Verizon are a part of the transportation and public utilities, telephone communications, except radio telephone industry. Its rival is Verizon. This industry is engaged in supplying telephone, voice, and communication in public. In 2016, AT&T was planning to merge with Time Warner as a way to increase growth, investment, jobs, and wages for its investors in the company. It was blocked by the U.S. government that following year, but AT&T is planning to continue and present their case in court. Additionally, they are planning to be the first U.S. company with 5G data to deliver and connect people with high-speed data across North America. The two priorities for AT&T are investing for growth and providing their investors with constant cash returns through dividends. They have had constant cash returns due to high return of investments over the past 5 years. AT&T believes that moving towards a merger with Time Warner will improve their dividend ratio. AT&T's high long-term debt increases due to their anticipated acquisition of Time Warner Inc. and an increase in interest rates. The higher interest rates and debt balances are also due to their acquisition of DirecTV, and it is expected to increase in 2018. The decrease in their EBIT is due to their decrease in revenues and a greater increase in operating costs. This has also impacted their net income. It shows a decrease in their revenues, but interest has increased greatly, causing net income to increase as well. From the balance sheet, it is noticeable that AT&T has improved their net working capital. The increase in their current asset has helped improve their net working capital from negative $12,207 million to negative $2,243 million. Additionally, it is noted that their debt has increased significantly from $123,513 million to $164,346 million due to an increase in short-term debt. Common stock issuance has stayed the same as well as their shares outstanding. Their total equity has increased from $124,110 million to $142 billion. EBIT has decreased due to a decrease in revenues and increase in operation costs. Net income has also increased from $12 to $29 billion. Free cash flow has slightly increased from $16,936 million to $17,601 billion.
Analyzing the financial statements for AT&T, I'll start off with the balance sheet first. Because the balance sheet states a firm financial position at a specific point in time, we can see that the net working capital for AT&T have changed dramatically for the years 2016 and 2017, with about $10 million difference. This indicates, or we can see, that AT&T almost doubled both its current asset and current liabilities for the year 2016 and 2017. Also, we can also see that the total debt has also dramatically increased with about $43 million difference from the year 2016 and 2017. This is not a good indicator because this indicates that the firm is highly leveraged, also indicates that the firm will be very risky and investors might not want to invest their money in a firm that's highly leveraged and very risky. Second, I'll move to the income statement. The income statement summarizes a firm's revenue, expenses, and profits during the reporting period and is available for common shareholders to view. AT&T's income statement did not have major differences. However, we can see that the earning before interest and taxes has decreased with about $500,000. This reduction is mainly due in the reduction in net revenue as well as high operating costs and weak productivity, which lead us to the dividend per share. As we can see, the dividend per share also decreased, which is due to the reinvestment in the firm's operations and poor earnings. Thirdly, I'll move to the cash flow. The cash flow, by definition, free cash flow is the amount of cash that can be withdrawn without harming a firm's ability to operate and to reproduce future cash flows. For AT&T, its cash flow statement has done dramatically well. As we can see, the income statement has increased from 2016 and 2017, as well as the free cash flow has also increased and is also positive for both years, which indicate that the company has enough cash to finance its fixed assets and investments. Moving on to AT&T ratio analysis, I'll start off with the liquidity ratio. For the liquidity ratio, we can see that both current and quick ratio are under 1. However, they increased and in 2017 they're both closer to 1. As for the current ratio in 2017 it is 0.97, which is closer to 1, and for the quick ratio it is 0.82, which is also closer to 1. For the asset management ratio, we can see that while the inventory turnover decreases, the day sales outstanding increases, the fixed asset turnover decreases, and also the total asset turnover also decreases. For the debt management ratio, the total debt to total capital ratio dramatically increases while the time interest earned decreases. For the profitability ratio, all profitability ratio actually increase. We can see that the operating margin, the profit margin, the return to total asset, the return to equity, the return to interest invested capital all increased. I'll talk about it a little bit more while comparing both competitors, AT&T and Verizon, to their industry. For the market to book ratio, we can see that the price per earning dramatically increased while the market to book value decreases.
We will compare AT&T and Verizon's ratios along with the industry ratios. Both companies' liquidity ratios are poor as they are supposed to be greater than 1. That being said, Verizon's liquidity ratio is better than AT&T's in 2016, and AT&T's liquidity ratios are better in 2017. They are both behind the industry standard, however. For the asset market management ratios for all the ratios except days sales outstanding, the higher the ratio, the better. In 2016, Verizon had the best inventory turnover ratio and fixed assets, while AT&T had the best days sales outstanding and total asset turnover ratio. In 2017, Verizon had the best ratios in all except days sales outstanding.
Moving on to the profitability ratio comparison between AT&T, Verizon, and their industry. For the profitability ratio, we can see that Verizon outperformed both AT&T and the industry for all profitability ratios. For the operating margin, you want to have the highest possible because that's how much money or sales that comes back after the operating cost. Same for the profit margin, the highest the better because that measures the net income per dollar sales. For the return on total asset, you also want to have the highest the better because that shows that Verizon is using its total asset effectively to generate net income. Same for return on equity and return on invested capital because that shows the overall investors' supplied capital. Moving on to the debt management ratio comparison between AT&T and Verizon to their industry. For the total debt to total capital, we can see that Verizon has the best total debt to total capital because it's the highest. For the total debt to total capital, you want to have the highest because that is the percentage of funds provided by creditors. For the time interest earned ratio, you also want to have the highest because that is the firm's ability to pay off its annual interest payment.
For the price earning ratio and the market book ratio, Verizon has the better ratios and it is also the closest to the industry ratios. For both of them, having a higher number means better ratio.
Conclusion. Looking at both of the company's financial statements and ratios, we conclude that Verizon is in a better financial spot than AT&T due to AT&T's high debt totals. We think that AT&T's merger with Time Warner is not financially feasible due to the recent acquisition of DirecTV. The ratio comparison from the previous slide shows that Verizon is doing much better than AT&T.